Stop. If you are sitting on the sidelines because you think you need 20% down to buy a home, you are losing money every single day. That outdated rule is the single biggest barrier keeping renters stuck in the trap while property values leave them behind. We have all heard it from our parents or old-school financial gurus. They say, don't buy until you have 20% saved. It sounds responsible. It feels safe. So you grind, you sacrifice, and you watch your bank account grow slowly, thinking you're doing the right thing. But here's the problem with that logic. While you are aggressively saving cash, home prices aren't staying still. They are appreciating. By the time you finally save that full 20% on a $400,000 home, that same house is likely worth $450,000. The goalpost keeps moving further away, making your hard-earned savings effectively worth less. Let's look at the reality. According to recent market data, the average first-time home buyer actually puts down between 6 and 7%, not 20. Even wealthy investors rarely tie up all their cash in down payments. They use leverage to maximize their returns. Why shouldn't you do the same? You have options that the banks do not always advertise loudly enough. There are FHA loans allowing you to buy with as little as 3.5% down. If you are a veteran, VA loans often require zero down. These programs were literally designed to help you build wealth, not restrict it. Even conventional loans, which most people assume are strict, often have programs allowing for just 3% down if you have a decent credit score. This means on a standard starter home, instead of needing 60 or 80 grand, you might get the keys for under 15,000. That is a massive difference in accessibility. Now, I hear you asking, but what about PMI? Private mortgage insurance is the bogeyman everyone fears. Yes, it is an extra monthly cost, but compare $100 a month in insurance against home prices rising by 10% a year. Paying a small fee to lock in a purchase price today is often cheaper than waiting. There is actually a strategic danger in putting too much money down. If you dump every penny of your liquidity into the down payment, you become house poor. You have equity, but no cash for repairs or emergencies. It is financially smarter to put less down and keep a cash buffer in the bank for peace of mind. Another misunderstood avenue is down payment assistance programs. Many lenders allow family members to gift you the down payment, or local governments offer grants to first-time buyers that act as silent secondary loans. You might be eligible for thousands of dollars in aid that you haven't even looked for yet because you assumed you weren't qualified. Real estate is a long game. The strategy isn't to wait for the perfect moment with a giant pile of cash. The strategy is to get into the market as soon as you can comfortably afford the monthly payment. You can always pay down the principal later, or remove insurance once your equity grows naturally. Think of your first home not as a forever mansion, but as a financial stepping stone. By putting less down now, you stop paying your landlord mortgage and start paying your own. You begin the cycle of appreciation. Waiting for perfection is just procrastination dressed up as financial responsibility. The best time to buy was 5 years ago. The second best time is when you are financially stable, regardless of the down payment percentage. Don't let a myth dictate your future. Tell me in the comments, are you still saving for 20%, or are you ready to explore low down payment options?